Good evening. Welcome, my friends. Here we go again. It's P7 time. Yay! And it's time for class numero 4, number 4. Plan. Tonight is a big night on the course because I think you might agree that the first 3 sessions have not been too painful. If you think what we've seen so far, hi Philsey, we have had what? We've had a bit of money laundering in chapter 1. If you know it, keep a lookout for it, not too hard. We've had a couple of audit standards, nothing too exciting. We've done the ethics stuff and professional issues. Didn't seem to kill us off too much. Hi Nizan. What else have we done? We've done some liability stuff in chapter 2. We've done practice management in chapter 3. But if I'm being honest, we've done the easier bits of the course. There is some application within them, and we've done a bit of practice. But tonight, we're going to have a ball. We're going to have a real good time. Sorry, I'm starting to sing Queen songs. This is not good. Because tonight, we get into the first big core topic. Ethics, professional issues, that's very important, and you'll see again tonight that it is. But the 2 biggest topics on the course are risk and evidence. Guaranteed questions on both, easily 30, 35, 40 marks on the paper on those topics, almost certainly. So, tonight is an important night because we cross a bit of a bridge tonight and we go from the not so difficult stuff to stuff that is going to tax our brains a bit. Hopefully not too much. What I'll do is I will take you through a quick reminder of what we saw last time just to get us back up to speed, and then we will get straight into chapter 4 and more importantly into a question. So, if we do that, and I wave my arm around at the screen, we can begin. Okay, my football team, of course, you might think had a terrible day yesterday, but I thought QPR would lose about 6-0 to Manchester United, and to be frank, losing 4-0 didn't seem to me a complete disaster. So, I could be happier, but it could be worse. Yay. Here we go then. Let's go take a look at what we were doing last time. Not chapter 1, no. Past all that nonsense. Ooh, now, I say we're going to look at what we did last time, but have I actually got the wrong bit of the notes up? Yay, I've got the wrong bit of the notes up. Stupid me. Okay, well we won't do that then. We'll go for a simpler approach, because the great thing about tonight is, frankly, we don't need the notes anyway, because we're not going to use them. I know, you see. It's interesting, we're about to do planning, because there's an old saying that says, fail to plan, plan to fail. Hello, guilty as charged. All right, thankfully I know what I'm going to tell you anyway. So, what did we do last time? Like a TV show, isn't it? Last time on P7. What did we do? We looked at practice management. Chapter 3 of the class notes, if you're interested. And what did we do in there? We looked at quality control. And what did we see with quality control? We saw there was a list of things that you needed to know. So, for example, we said on every audit we want direction of staff, so make sure people know what they're doing, supervision to make sure they're doing it, review of the work that everybody does, make sure you spread the work out, sensible basis, difficult stuff goes to complicated staff, easy stuff to more junior staff. So we went through that sort of stuff. The reason we did that is that if you know those rules, if a practical question comes up, you can attach the rules to the question. So if you do a question and a junior member of staff seems to have disappeared off and done stuff they shouldn't have done, when you explain it, what word are you going to use? Supervision. There seems to be a lack of it, because if they'd been supervised, they wouldn't have wandered off, would they? So quality control, we saw, was both for the firm as a whole and on each job. And as I just said, make sure you know this stuff, because if anything practical comes up, if you can use the criteria we see in the notes as your explanation for the points you're making, then you must be on the right track. We also looked at advertising. And that was a bit like quality control, because that had some criteria, or rules if you like, as well. I'll have put some silly advert up on the screen suggesting I'm the greatest person in the universe or something, and we use that to help understand the criteria. So if I say, get your audit from PricewaterhouseCoopers because Ernst & Young are rubbish, you know that that's wrong, everyone knows that's wrong, but you get the marks for saying you cannot make adverse comments about other professionals. So you tie the story back to the rules. You see? Not too difficult at all. We also looked at fees, where we reminded ourselves that there's only two things to remember, and that's about lowballing, going in cheap to try and win business, which of course you are allowed to do, and the one you're not allowed to do, which is called contingency fees or contingent fees. So that's okay, I suppose. That one, no. What else did we do? Oh yes, we did an interesting little game with tendering, didn't we? Where I tried to make it clear to you that when audit firms try to win a client, it's pretty similar to you trying to get a job. So the game we played is, imagine you're trying to get a job. What do you put in your CV, your resume? Because that, of course, is your proposal. It is your presentation to the potential employer. What sort of things do you want to explain in the interview? What message are you trying to get over? Presumably you're trying to show you understand that company and can explain how you would do benefits for them, because hopefully then they'll employ you. There was a little bit at the end of chapter 3 reminding us that before we take on new clients, we do need to consider all the usual stuff. Have we got the staff? The time? Can we meet the client's deadlines? Preconditions for an audit? Professional clearance? Talk to the outgoing auditor? And then sign an engagement letter. But to be honest, that stuff is all pretty basic for P7, so I wouldn't get too concerned about it. So that was chapter 3. Right at the end, I think I gave a very quick reminder that chapter 4 would be starting with risk. But this is such an important topic that before we head to a nice big juicy 34-mark case study question, yeah, the big ones, I am going to remind you what you're already meant to know and what you need to know for P7 to be able to do the questions. Okay? When you sit the F8 paper, you cover a topic called audit risk. And audit risk can come up on P7 as well. However, there's actually 3 types of risk question you can be asked. Now, in order to help understand that, let's just have a reminder of what audit risk is. I think we saw this briefly at the end of last time, but it's a good way to start up tonight's class as well. Audit risk is the risk the financial statements are materially misstated and audit work, tests if you like, fails to detect this. So if you prefer, the accounts are wrong and the auditor doesn't spot that the accounts are wrong. Result, you give the wrong audit opinion, saying the accounts are true and fair, when in fact they are not. Two reasons why company accounts can be wrong. The nature of the business and its transactions. Fraud and error are the two types of mistake. I'm looking at for the two reasons behind the mistakes. So one is the nature of business and its transactions. I'll just help answer your question a bit more as I do this. So for example, if I'm auditing a bank, banks have a high risk of mistakes because banks have complicated transactions. Now, I'm not talking about deliberate, I'm talking accidental, because it's complicated. Of course, by the same argument, you could say if they've got complicated transactions, clever members of staff at banks might deliberately put mistakes in the accounts, fraud, because they think they'll get away with it, especially if they're getting bonuses based on profits, of course. This one is called inherent risk. And the other reason why accounts can be materially misstated is weak control systems. And that is called control risk. Absolutely. So, the risk of material misstatement is inherent risk, control risk. But to complete the audit risk model, we have this one, which of course is detection risk. Right. So then, you can get a question on P7 that says, here's the story. Describe the audit risks in that story. And if you get an audit risk question, you're looking for risks of material misstatement, inherent control risk in other words, and detection risks. However, a second style of question is she might ask simply for the risks of material misstatement. If she does that, well, clearly she doesn't want detection risk, she just wants the risks of material misstatement, which is inherent and control. Now, at this point you might be going, oh, this sounds complicated. Don't look at it like that. On P7, even in an audit risk question, there won't be many, potentially no detection risks at all, because on P7, she's trying to test whether you understand the accounting implications of what you're reading. And the accounting implications are the inherent risks. So even on an audit risk question, the answer will almost certainly be entirely risk of material misstatement with no detection risks. So in other words, whether she asks for audit risk or the risk of material misstatement, my advice for exam preparation is assume they are the same. Just do risks of material misstatement. Why are their accounts at risk of being wrong? Even if there are a couple of detection risks, you won't need them to get full marks, so keep life simple. Pretend it's the same. To be honest, I don't really know why the examiner insists on using both terms, because the answers end up the same anyway, so what's the point? However, just to really confuse you, there is another type of risk question as well. So we need to do this in a different colour. Because the other type of question that she asks is business risk. And this one is totally different to the other two. And this creates a huge potential problem for your answer. You see, I can go and take any old exam question that says, let's say, audit risk, and I can cross out audit and write business and completely change the answer, but the story still works. So the big danger with risk questions, or danger number one, is you don't read the requirement properly, or you read it, but you don't stop, take a deep breath, and make sure you know which type of risk it is. Because if you give a business risk answer when the question says risk of material misstatement, do you know how many marks you're going to earn? 0. Absolutely nothing, because you won't have answered the question that's there. Every explanation will be wrong. You'll pick up the right issues, but then you'll explain it without any risk of material misstatement indicated at all. So this is important. And in order to get us into the idea, before we go look at a question, here is a little example. Let's imagine the scenario looks something like this. Now, obviously, I'm not going to give you a page and a half yet. Let's just have one point that could appear in a scenario, and we'll see what happens. So, scenario says, your client is due to replace a lot of older assets before the year end. However, due to cash flow problems, the board has decided to postpone all asset renewals for 2 years. Now, here is where we have a bit of a risk. A risk. Because you will look at that story and your brain starts to do things with it. Don't. You don't know what the question is yet. The question might say requirement. What is the capital of Poland? Obviously, it's not going to say that. But my point is, for that story, there can be more than one question. So let's see what the question might be. And as you've probably guessed, there's going to be more than one. Because what I'm going to ask you to do is this. I want you to describe from the above scenario and we'll put the business risks over here, and we'll put the risks of material misstatement over here. Now remember, the risk of material misstatement and audit risk are almost always exactly the same thing, because the risk of material misstatement is the biggest part of audit risk. It's one part of the other. Okay, so from the story, if it says business risks, what do you say in the answer? Well, what is a business risk? A business risk is quite simply the risk to the business. Ha ha ha, what a surprise. What does that mean? It means what is the potential damage to a company if what's happening in the story is happening. How is there potential damage to the company? So with this one here, you think company. Okay, so a company would normally be replacing its assets around about now, but has decided to delay it 2 years to preserve cash flow. Okay, let's just think it through. If you don't replace assets that you should have replaced, what might go wrong for your company? Well, if you keep using older assets, you'll have to repair them more often, so repair costs go up. Depends what the assets are, I suppose, but production efficiency likely to reduce. You can't make as much because your assets aren't as good, especially if they break down regularly. And breaking down leads to disruption. And if you're producing less, I suspect you will be selling less. And also it could cause quality problems. And that could lead to an increase in refunds and damaged reputation. Now, of course, there's lots of potential things we might say here. More health and safety problems might also occur. Because, of course, older assets, more likely to injure someone. You could get claims by staff. Your staff morale is going to fall because they're working with older assets, lower quality. This could have impacts on your customers. It could have impacts on your staff. It can cost you a lot of money by not replacing them. So you're taking a bit of a risk. Could cause you a lot of problems. Now, the business risks there, I hope you agree, are largely common sense. It's not really that complicated, is it? Risks of material misstatement. So forget about the business risks. Now what we're asking is this. If a company does not replace assets that it would have replaced at this point, what are the risks of material misstatement? Well, this is talking not about the company, but about the company's accounts, its financial statements being wrong. So which numbers in the accounts might be wrong? Well, I guess we start with assets, don't we? Imagine you've got an asset that's due to last for 4 years. Except now you're going to keep it for 6 years. Now, there's a very interesting point been made here. Overstatement of assets. Very interesting. Most people's brains assume that's the answer. In fact, surely it's the opposite. Because surely you're depreciating your assets too quickly, because you'll depreciate over 4 years when in fact you should slow down and do it over 6, which means the asset value in the books is going to fall to 0 too quickly. I would argue IAS 16, depreciation is no longer matching useful economic life, UEL, I would argue understated assets is your main problem. Just thinking through the accounting standards, doesn't IAS 1 and to an extent 8 as well, do they not suggest you have to disclose your accounting policies? Well, if this company has changed its depreciation because it's realized it now needs to spread, if the depreciation method has been changed, now I would argue the risk is that they're still disclosing the old method. So I'm trying to argue what could go wrong in the accounts because of this. Again, if they've done it all correctly, I might go further and say, oh, they might have mistakenly tried to do a prior year adjustment thinking they are changing accounting policy. but they're not changing accounting policy. They're changing the measurement of the useful economic life. The policy is spread the cost over the UEL. That was the policy before, that's the policy afterwards. It's the measurement of the useful economic life, and that is not done as a prior year adjustment. So there's another mistake they might make, wrongly putting through a prior period adjustment when they shouldn't. Change in accounting estimate, absolutely. Measurement estimate, whatever you want to call it. Okay, let's take a look at those two answers, because there's a reason we're doing this, and what do we notice? They're totally different. Totally, utterly different. And that is the point I'm getting over. From one story, we've looked at it in two totally different ways. Impact on business, impact on businesses' accounts. Now, there is one more point I would say here, which is we can potentially link these two concepts together. Because if you believe that all of those business risks are so severe, that could perhaps threaten your client's going concern status. And if it potentially affects the going concern status, well, going concern is an accounting concept. Whoop. So now I would be saying IAS 1, what is the risk under disclosure of going concern threats, as they are a requirement, the disclosure of those of IAS 1. The point I want you to get here is the nature of how I'm explaining things for each of the two requirements. So let's conclude that. Just before I conclude that, suddenly you're very talkative. Eleni, can we say that cash flow problems can relate to going concern issues? Yes, absolutely. Any business risk can relate to going concern, as I was just saying. So yeah, Perskis, just in answering your point, yeah, the logical flow is if a company's in trouble, risk of material misstatement, going concern. So business risks can lead to the risk of material misstatement. Absolutely. So in summary, what's our technique? Firstly, for a business risk question, well, if you're explaining business risks, you've got to keep telling yourself to explain it in terms of damage to the business. So think about decreased sales, increased costs, cash flow problems, think of reputation damage, what else? Fraud. Could be virtually anything, couldn't it? Inefficiency can wreck a business. Customers no longer liking the business's products. Competitors getting an advantage. It could be anything. Just make sure you explain it clearly in terms of damage to the business. That is the key. Whereas, if we get a risk of material misstatement question, or, since it's pretty much the same thing, an audit risk question, now what is my approach? Well, now my approach is which accounting standard, IAS or IFRS, is relevant to the situation. Specifically, which rule from that IAS or IFRS do I think they're at risk of breaking? And then Do I think the risk is overstatement or understatement or a disclosure problem? If the question has got numbers in it, mention the numbers in the answer. If you think assets are at risk of being overstated by 20% because 20% of the assets don't look right, fine. If there are numbers, use them. But the numbers are less important. The key here is the explanations. So that is our approach for each of the two different types of risk. And what we are going to do now is we are going to start looking at a question. Now this question is going to take up a big chunk of this evening, probably the rest of the evening in fact, because it's a big question. It's got 4 separate parts to it, and 3 of them are core exam areas that come up over and over again. The question is in the revision kit. Oh yes, in fact there it is. Let's just level this up. And if you turned to page 149 of our revision kit, you will find something that looks a bit familiar. Right, I think we can do that. Because this is the June 08 exam paper. So there we go, page 149 of the revision kit. And of course we've already had a go at one of the questions on this paper, because the ethics professional issues question we did last class or the class before was also from this. But now we're going to be looking at question number 1. Let's just line it up. Okay, and the first thing we find with this question is there is a fairly big story. It's a page and a third, page and a quarter, not quite a page and a half. So it's going to have a lot of detail in it. There is no point looking at the detail until we've got some idea of what we're trying to achieve. So the starting point, as with all questions, is the requirements. Let's go take a peek. First thing we notice is, to help you guys out, I've told you what today's date needs to be. This paper was 2008, but I've updated some of the dates to make it feel a little more current. And for the dates in the question, it will be December the 4th, 2010. Part A. I notice there are 12 marks. Marks are very important. They tell me how much I need to produce. It says, using the information provided, so the story, identify and explain. Now, your examiner uses these words a lot, identify and explain, or identify and discuss. And the reason she likes to do this is because it means that there'll be half a mark for every point you identify. So simply repeating some information from the story and saying that's an issue, and then up to another mark for the quality of the explanation. So given this is worth 12 marks, if you explain your risks well, you only need 8. I would advise that for safety, because you don't know how good your explanations are going to be, and in the exam hall they can sometimes get a little weak, I would suggest that if it says 12 marks, I'd aim for 12 risks. You might not find 12 risks, but then to be honest, you'll probably explain some of them fairly well, so you don't need 12. But for safety, set your target as 12. If you end up getting half of that, 6, well, as long as you make an attempt at explaining all 6 of them, you'll probably get 6 out of 12, and that's good enough for a pass. And you will try and explain all of them, won't you? Because I keep telling you, explain everything, say the word because. What I can't do is guarantee your explanations will be fabulous, because that's down to you listening to me, thinking the right technique, and of course practicing, preferably before exam day. So, what are we identifying and explaining? The principal business risks. Now it says principal because of course there are some risks that affect every company. You know, the economy might go work against you, the government might get nasty and put business tax rates up, but that's not specific to the story, that's just everyday life. So when she says principle, she means use the information. Don't start guessing basic risks that affect everybody. The moment you see business risks, you need to stop for 5 seconds and think, okay, business risks, I therefore need to focus on the damage to the company. Increased costs, reduced sales, reputation damage, etc. And as long as you frame the business risks in that sort of language, you are going to earn a lot of marks fairly quickly. Okay, so part A, I now have a plan of attack. And you might say, go read the story, let's find some business risks. But I say no. And there are 2 reasons for this. This is a 4-part question. You can guarantee at least one of the other parts will also require practical application to the story. And I don't want to read that story more than once, because it's huge. I don't have time. And there's another reason why it's not a good idea to go read the story right now. And that is, the moment you read the story, your head is full of story. No. No, 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 no. What you need to do is read the other requirements and make sure you've got your technique lined up for each of them. Don't go and read the story, because the moment the story fills your head, it shunts the technique out of your ears and you forget it. So, we will plan all of the requirements and then read the story, and we will plan our answer for all of it as we go through the story just once. B part 1. Now B part 1 is the smallest part of the question and is also a technical question, as it says the relationship between concepts. Please don't worry too much about this. I am going to cover this with you at the end of the question because it's the least important part and because you can just learn it. But there is one thing I do need to highlight, and that is this. What? Is this another type of risk? No. You do need to know purely so that when you're attempting older exam questions, you know what it's talking about. And that is that the risk of material misstatement used to be called financial statement risk. When the audit standards got updated in about 2010, I think it was, yeah, 2010, the examiner switched from calling it financial statement risk to the risk of material misstatement. It's the same thing, okay? Okie dokie then, where are we? There we are. So, B part 1, forget it. We'll deal with that at the end. But B part 2, whoops. Let's just have a change of colour scheme here. B part 2, worth 6 marks, says identify and explain. Ooh, same again. Half for identifying, 1 for explaining. The potential financial statement risks, let's cross that out, shall we? Risks of material misstatement caused by the breach of planning regulations discussed in the press cutting. Well, when I see risks of material misstatement, I think, ooh, technique. And the technique for these, as I just mentioned, is which accounting standard is it? Which rule do we think we might be breaking? Well, they. And I'm going to run out of space. Do we think they will understate, overstate, etc.? And those are the three things I'll be looking to say. It's worth 6 marks. It says identify and explain, so probably I'm looking for 4 at 1.5 marks each. But as with the business risk question, I'm going to aim higher, and I'm going to aim for 6, just in case my explanations are a little bit dodgy. It does say specifically caused by the breach of planning regulations discussed in the press cutting. When we get to the story, we'll find that that is just this bit here. So in terms of explaining B part 2, if you think you can see risks the accounts might be misstated outside of that box there, we'll ignore them, because for this question that's not what she's asking. Part C is worth 12 marks. Again, another big bit. But I notice here that there are 2 professional marks. Now, I don't want to get too excited about professional marks at this stage of the course. They are more of a revision course issue. But the reason there are professional marks in here is this. Because you are not just writing an answer, it has to have a format. In this case, briefing notes. Your examiner has set briefing notes 14 papers in a row, and she's only ever written 14 papers. So let's face it, you're doing briefing notes in December, because she always sets them. At the end of the exercise, I'll just explain what briefing notes are meant to look like. Please bear in mind that if she set it 14 times in a row, if you want to know what briefing notes look like, go and look at any of her exam answers on the ACCA's website, and then you'll know. But I will be covering it. In this question, there's only 2 professional marks. The way she does it now, recently changed, is there are 4 professional marks, and they'll all be in one question, probably question 1. In the old days, she used to split them, 2 professional marks in one question, 2 in another. Doesn't make any difference, but just thought I'd explain it. Given there are 2 professional marks included, that 12 is in effect a 10, because the content of our answer needs to fill 10 marks. The question says, prepare briefing notes to be used by an audit partner in your firm, assessing the professional, ethical, and other issues to be considered. Ooh, it's another ethical professional question. And because it's ethical professional, we go back to 2 weeks ago, and to an extent a little bit of last week, and we remind ourselves that ethical professional means, well, the ethical stuff, 4 things we considered. We're looking for threats to objectivity, SSAFIM, self-review, self-interest, avocados, no advocacy. We are thinking any confidentiality issues. We are thinking conflicts of interest and integrity of client, C of I and I of C. And professional issues, I'm thinking any clues of money laundering, any issues about my auditor liability. I'm also thinking practice management, and any impact on my audit process. And that is how I will go about considering Part C. It says issues to be considered in deciding whether to proceed with the appointment as auditor of Medix. So we're not the auditor yet, we're trying to decide. But that doesn't change the plan. I mean, look at the lists. When are you normally thinking of threats to objectivity before accepting a new client? It probably means confidentiality won't be an issue, because if they're not your client yet, you don't know anything about them that could be confidential. Conflicts of interest could be, you consider that before accepting new clients, and you consider integrity of a client before saying yes to them. And all the other issues, money laundering, liability, etc., would all be issues that would certainly be of interest before saying yes to a new client. Fantastic. So, to conclude, we are about to go read the story. What are we looking for? For part A, we're looking for damage to the business risks. For part C, we're looking for ethical and other professional issues. And for part B, we're not looking for anything until we get to the box at the end. And when we get to that box at the end, the cutting from the newspaper, we're looking for reasons why this company's accounts might be wrong. Right. Now, as I said, I am aiming to plan this answer all in one go. As before when I did a question with you, this answer plan will be way too detailed for your own purposes. I'm doing it detailed because if I went at my speed in the exam hall and wrote what I want to write, I'd go too quickly for you and you'd look at what I'd written and go, I don't understand what that means, because I write very short letters, numbers, virtually no words, because the plan is there to tell me what to write as my full answer. You write in your plan whatever helps you. Some people don't write the plan down. They just go through the question highlighting stuff, and if that works for you, that's fine. Personally, I think planning it on a piece of paper makes more sense. So what I'm going to do is we'll have A, business risks over here, B, risk of material misstatement press story, so the newspaper cutting, and then C, ethical and professional issues over here. And just for my own benefit, a reminder, I'm looking for 12 marks worth of that, 6 of that, 10 of that. Interesting question. In the exam, if you run out of time, will the Palm earn any marks? Sorry, Nikita, I'm being harsh. Yeah, I know what you mean. Will your plan earn any marks? Do you want the official answer or the unofficial answer? You want both, I know. The official answer is no. The plan counts for nothing. Absolutely nothing. To be honest, in the first 15 minutes of the exam, when I've got reading time, I will go through the requirements of all 5 questions on the paper and plan my tactics, my technique. So I will be doing that stuff there. I'll do that in the first 15 minutes. And if I finish that within 15 minutes, and I probably will, because what I've written on there will take me about 1 minute. And there's only 5 questions, and this is the biggest one. What I'll then do is start reading the story, and I will plan on the question paper, because I'm not allowed to write on the answer paper yet. So there's a very strong chance the examiner won't see my plans because they're not in the answer book. So the official answer is no, they don't get counted. Probably shouldn't tell you this. Unofficially. Very, very, very unofficial. Let's say I'm marking your exam. Let's say you've got 49%. And let's say, as I read your answers, I thought actually you were pretty good. And I now add it all up at the end and I think, oh, 49, really? Well, if you're lucky and I'm on a good day, I might just go back through and think, hang on, I thought this person felt like a pass to me, I'd assumed they'd got mid-50s, and now you're telling me, computer, I've only given 49. I might just flick back through, and if I see an answer plan and I think, you know, they were right on the money with that, they just didn't get time to write it all out, maybe I'll give you the extra mark. Now, markers are not meant to do that because we have to justify every mark we give, so it's a dangerous tactic for me, to be honest, but I like to operate in the spirit of fairness, and if I think you should pass, I think it's fair you've passed. Most markers just take the money for marking. They get to the end, they don't really care if it's a 49 or an 83, because it's not their problem. So my advice would be, do the plan as quickly as possible. Don't be afraid of doing it on the question paper, because frankly, chances are no credit. Right, here we go then. This will be an answer plan. Every interesting piece of information in the story, I'm going to ask myself, does it affect A or C? And when I get to the last bit, the press cutting, the newspaper article, I will focus on B, but of course the newspaper article itself could affect A and C as well. Here we go then. So up we go to the beginning of the story. Whoops, not quite that far. Here we go then. You are a senior audit manager in Mitchell & Co., a firm of chartered certified accountants. Well, you being the audit manager is not a risk. It's not a business risk. It's got nothing to do with this company's accounts being wrong, and it's not an ethical or professional issue. Anyone could be the manager. Everything's cool. You are reviewing some information regarding a potential new audit client, Medix. Well, new clients, less understanding of that client. You could therefore argue detection risk has gone up, and it has. But detection risk is part of audit risk, and the question's not asking that. I suppose you could argue at a push that if I say professional issues in part C includes impact on audit, the fact that it would be a new client, I suppose we might just about push and say that we would need increased planning time because the client is new. Not exactly the most exciting point ever made, and it might not even get any marks because the examiner may feel that it's too basic. But it is true. Back we go. Oh, not to there. No, 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 to there. Medix, a supplier of medical instruments. Right, medical instruments. That sounds like it could be quite complicated. I mean, if they supply chocolate bars, I know what a chocolate bar looks like. Medical instruments, ooh. Am I going to know what this stuff is? Okay, stop though. Let's go through. Part A, business risk. Is it a business risk? Is this a risky business to be in? Well, normally I'd say probably not. I mean, there'll always be hospitals, and people will always go to hospitals, and therefore doctors will need medical equipment. Sounds like a fairly safe business to me. Ethical and professional issues. Medical instruments. Well, there's no ethical issue here. Professional issues. No indication of money laundering. No issues about my liability as an auditor. Practice management, fees, tendering, quality control. I mean, nothing is springing to mind at the moment, except a sort of crossover point between practice management and impact on audit. If you have got a client with specialist inventory, then possibly one thing we'd want to write in the answer is because they have specialist products, maybe we'd need some specialist staff. Maybe even an expert to help us with things like the stock take and understanding which stock is which, and maybe some valuation issues. So perhaps. Still a bit basic, but you know, it's a fair enough point. Back we go. Extracts from notes taken in a meeting that you recently held with the finance director of Medix, Ricardo Feller, are shown below. Okay, so here's the interesting stuff about to happen. This meeting was held at notice on the 1st of December. Today's the 4th. It was only 3 days ago, which tells me that very little will have changed since the meeting. Only 3 days. Right, here we go. Medix is a provider of specialised surgical instruments used in medical procedures. Well, yeah, we know that already. The company is owner-managed. Well, lots of companies are owner-managed. LSBF is owner-managed. So what? If there's only one owner, you could argue there's a business risk, because if the owner dies, the management is dead. But there's no indication it's only one person. It could be 25 managers own it. It could be spread over quite a few people. So I can't see that on its own as being a concern. They've got a financial year end of the 31st of December. So the year has not finished yet. It finishes, what's today, the 4th, in about 4 weeks' time. And given they sell products, there'll probably be a stock take happening at that point. They've invited our firm to be appointed as auditor for the forthcoming year end. The audit is not going out to tender, so that tells you one practice management issue that's not going to be raised here. Tendering is not relevant. They've asked us to be auditor. If we want it, it's our client. Owner-manager, you see. The managers invite us to be the auditor and then propose us to the owners, and they're the same people. So if we want it, this is our client. It then says, Ricardo Feller, who is the finance director, has been with the company since July, so about 5 months, following the departure of the previous finance director, who is currently taking legal action against Medix for unfair dismissal. Ooh, I sense we've got some information. Right, is it a business risk if the previous finance director is suing the company? Well, if you can turn it into costs going up or profits going down or reputation damage or something else, yes. So it's a risk then, isn't it? Ex-FD sues, and that's likely to get into the newspapers. And then you've got legal costs. And of course, if you lose, compensation, and directors do not get paid small salaries, which means any compensation probably will be lost salary related, could get rather expensive. Pretty clear business risk, I think you would agree. Let's go over to part C, any ethical and professional issues. Just factor through the lists. Ethics, threats to my objectivity as auditor. No. Conflicts of interest with another client. There is no other client. We've only been told about Medix. Any confidentiality issues? Unlikely. We're not even the auditor yet. What would we know at this point that would need disclosure? What have we missed? Integrity of client. Ah, now that's a maybe, isn't it? Because if the finance director is suing for wrongful dismissal, it may mean that this board of directors wrongfully dismissed him or her. And if they wrongfully dismiss them, number one, that brings into question their willingness to play by the rules. And it also raises the question, why would you be getting rid of your FD who's now complaining it wasn't fair? Could it be that there is some sort of accounting issue? You know, finance director did something, rest of the board didn't like the accounting, so they sacked them. Or maybe the finance director said this is how it should be accounted for, and the board wanted to cheat, so they got rid of him. I don't know is the answer, but it could be something, couldn't it? We'd want to find out more about that before saying yes to this client. What's going on? What is the court case all about? What is the accusation? Okay, back to the story we go. Company background. Medix manufactures surgical instruments which are sold to hospitals. Really? I assumed they would sell them to a football club. Why are they telling us this again? Surely we know this already. Due to the increased use of laser surgery in the last 4 years, demand for traditional metal surgical instruments, which provided 75% of revenue last year, has declined rapidly. Uh-oh. I sense a business risk. Because if 75% of your business is in rapid decline, you have got a major problem. Surely that's going to affect your profits and going to give you cash flow problems. Major problem. So a clear risk to the business. Ethical professional issue. In my mind, I'm thinking threats to objectivity. No. Confidentiality. No. Conflict of interest. No. Integrity of client. No. In professional issues, I can't think money laundering for this. Can't think any liability issues. Practice management. Not really. Impact on audit. Yes. Because if 3/4 of their business is rapidly going downhill, surely this is suggesting going concern issues, and they are going to need a lot of time and staff on this audit, because if what I'm reading is true, this is a company with a big problem. And that will impact the audit, because a lot of audit effort will have to be aimed at assessing their future prospects. There is another issue, of course. Are they going to pay the fees? They might have gone bust by the time it comes to paying our fees. And that is a valid thing to consider. Okay, back to the story we go. Medix is expanding into the provision of laser surgery equipment. Good. But research and development is at an early stage. Oh dear. The directors feel confident that the laser instruments currently being designed will eventually receive the necessary license. Oh, it gets even better. You can't sell them until you've got a license. Well, all of that needs to go in the answer as well. It seems they are behind with their research and development, and there's a risk that they don't get the license, or it takes ages to get it, which will mean no sales, which equals no company. They are in big trouble. You can bring in time and dates and things if you wish into this. It says laser surgery has been growing in popularity, I think, over the last 4 years. Well, surely some of their competitors will be rather further ahead with this in the last 4 years than these guys are. Huge risk. There is currently one scientist working on the laser equipment, subcontracted by Medix on a freelance basis. Whoa, they're going for it, aren't they? One whole scientist! And they're not even an employee, they're freelance, which means presumably it's very easy for them to just not turn up one day and go, leave. They've got no control over this person who could go and work for one of the opposition. So yet again, another business risk. Now, if all you write in your answer is there's only one scientist and they are freelance, you'll get half a mark. You have identified. That is pure information from the story. You're not adding anything. If, however, you add not enough resource, and can leave equals R&D threatened, and remember no products equals no company, then you are now explaining your point and why it's a risk to the business. The only possible problem that can happen when you get a business risk question is in some ways it feels too easy and you just copy stuff out of the story and say, look at that. You've got to say because. This is a risk because. I know sometimes it feels too obvious. One scientist, of course it's a risk, but you've got to show you understand why. The building in which the research is being carried out has recently been significantly extended by the construction of a large laboratory. Okay, well now I might feel a little less concerned. They've only got one scientist, but at least they've built a nice big lab to do some research in. Maybe they'll hire more scientists in the near future. But at the moment I'm still nervous. They've only just got the building, they don't currently have the research staff, they don't have the products, they don't have a license. This is a company in a potential spot of trouble. A considerable revenue stream is derived from agents not employed by medics. The agents earn a commission based on the value of sales they've secured for medics during the year. Now, a lot of companies do this because they need people going out to all the hospitals around the world selling the products. Instead of employing people in the home country, they employ people on commission to go out and do it for them. There are many suppliers into the market, and agents are used by all manufacturers as a means of marketing and distributing their products. Is this a business risk? Well, it is, isn't it? Because if all your competitors also want to use the same agents, if you're an agent, who do you work for? Whoever you'll earn the most commission from. How do you earn commission? Selling the products. And Medix's products aren't selling anymore. So it seems to me that there is yet another risk here for the business, that the agents may leave to competitors to sell up to date products. That's got to be a risk, hasn't it? The agents disappear, and if the agents disappear and you're getting a significant revenue stream from them, that rapid decline in sales they've talked about will be even more rapid. This is looking worse every sentence we read, isn't it? The company's manufacturing facility is located in another country where operating costs are significantly lower. Understandable, lots of companies do it, outsource overseas where it's cheaper. But the moment you see overseas, we've got some risks. Because if they are overseas manufacturing, I'm thinking they've now got foreign exchange risk. They've got cultural risk. They've got political risk, depending on where that overseas function is. Control risk, because it's hard to control things that are thousands of miles away. What else? Overseas. Okay, that'll do for now. Legal risks, because there'll be different laws, won't there? All sorts of things that could cost money, disruption to the business. Now, I've been a bit naughty here because I'm doing all these business risks and I've stopped asking myself, is it also an ethical professional risk? I can't see how the only one scientist issue is ethical or professional. And if the agents leave, I can't see what that's got to do with ethical professional. Overseas manufacturing plant, ethical? Well, not for my audit position. Professional money laundering. Well, just having an overseas division doesn't make you a money launderer. Liability of the auditor? No. Practice management? No. Will it impact the audit? Yeah, it's going to, isn't it? Because if they have an overseas manufacturing outlet, that means we will probably have to send staff, e.g. for stock take. And don't forget, if you're saying it's specialist stock, you can't just find an audit trainee, stick them on an aeroplane and send them over there. You might have to send someone who knows what they're doing. And that's going to cost money, which has to be recharged to the client. It also needs organising, because the year end's only 4 weeks away, and as everyone knows, the price of airline tickets now seems to go up as you get closer to the date. And if you're flying around New Year, well, that's a very big holiday time, so you might not get a seat on a plane. So book a ticket now. Practical point, but fair enough, I think. Okay, now we're reading through a very big story here. We're trying to keep our focus on how to explain business risks, how to explain ethical other professional issues. How are we doing so far? Ethics professional, we've got 1, 2, 3, 4, 5. Looking for 10, we're almost halfway there, that's great. Business risks, 1, 2, 3, 4, 5, 6 at least, and some of them have multiple side issues. I'd say this is going fairly well. In fact, you know what I'm thinking? I'm thinking, with the rest of that page to read and the next page, it is very clear to me that we're going to have plenty of points to talk about. Now, if I was sitting in the exam hall at this point, I can see I've got a chance of passing part A and a chance of passing part C already in place. I would read a little bit further, maybe down to the bottom of this box, and then, remembering there's 6 marks in B part 2 we've not even tried to get yet, I might go and read that press cutting and see if I can make sure I can pass B part 2 as well. I mean, for all we know, we may have already got enough stuff to get full marks on A and C. So the moment you realise there's a stack of issues, you've got to get reading more quickly. Don't plan too much, get straight into the writing, but thinking technique as you do it. But if you can see a bit of the question you've not even tried yet, go take a look at it if you can. Try and get a plan together. But we're not in the exam hall, so we're going to keep going with our technique. The facility is under the control of the local manager, who visits the head office annually for a meeting with senior management. Are you for real? Once a year? Well, that tells me what to talk about with the control risk part of my answer then, doesn't it? Products are imported via aeroplane. It'll be quick. It'll also be expensive, I'd imagine. I lived in Singapore for 3 years, and that meant shipping my stuff there and then shipping my stuff back. If I'd sent it on an aeroplane, it would have cost a very large amount of money, but it would have got there very quickly. I went for the boat approach. It takes 4 weeks either way, so a lot of my possessions have done a very large world tour. Lucky them. But it was relatively cheap. So I don't know, I mean, aeroplane is good for speed, hooray, but bad for cost, boo. If you went by ship, it would be bad for speed, boo, but better for cost, hooray. Seems to me like it could go either way, and I've got so many other points to talk about. If I don't know, bin it, ditch it. You don't need it, there's too many other things to deal with. Go with the easier points. If you're not sure, forget it. The overseas plant and equipment is owned by the company. Good, I think. And was constructed 12 years ago. Sounds like quite a long time ago. Specifically for the manufacture of metal surgical instruments. Oh dear. So in order to sell the new laser stuff, they've built a building. Hooray. They're miles behind with research and development. Only one scientist who doesn't even work for the company. And then on top of that, they've got to get a license. And on top of that, they can't manufacture the stuff yet because their facilities are for the old products. I see another problem, because their plant needs a refit to produce the laser stuff, and that is going to cost a lot of money and is going to take time and may therefore further delay the new products. Whoa, a lot of business risks in this story. But I'm starting to get nervous now that my ethics professional issues bit of the answer is nowhere near as long as part A. So we've got to keep a lookout for those. The company has a bank overdraft and makes use of the facility most months, a significant bank loan, variable interest rate, currently being negotiated. So this company's got cash flow problems then, which of course is a business risk. Because overdrafts are an expensive way to finance your business. They tend to have a lot of short-term fees. The loan would be at a variable interest rate, which means if it goes up, it's going to cost more to the company. But there's another issue here as well. We have to ask the question, what if they don't get the loan? I mean, to a certain extent, what if they do get the loan? If they get it, they've got to pay it back, and that could wipe them out, the repayments. If they don't get it, their cash is stuffed, which means they might run out of money and not finish the research and development. This is just bad news all round, isn't it? Not good. The terms of the loan will be finalised once the audited financial statements have been viewed by the bank. I'm thinking ethics and professional issues. I'm thinking quite a few issues, in fact. Because this is what I'm thinking. Scroll through the list. Threats to objectivity. Familiarity? No. They're not even your client yet. Advocacy? No. Management? No. Self-review? No. Self-interest? No. Intimidation? Maybe. Because these directors are desperate for finance. Think of the picture that's being painted in this story. They desperately need research and development, but they're going to have to spend a lot of money on it, and they don't have a lot of money. That loan is critical. And the bank are going to look at the audited accounts, which means I suspect an intimidation threat may arise, because I suspect there may be pressure to present positive looking financial statements, which means we'll be under pressure as auditors not to find mistakes. Almost guaranteed. So I've got a threat to objectivity. Conflict of interest? No. Confidentiality? No. Integrity of client? Well, I'm not saying they will cheat, that they might. At the moment there's no evidence they're definitely doing it. And then I need to think professional issues. But Eleni is in here. Can this be related to advocacy, where the auditors may come to the place of representing the client? It will only be advocacy if the question then says the directors want you to go with them to the bank to try and help negotiate the loan. If you go with them, you're supporting their loan plan. Advocacy. Auditing a company's accounts is not advocacy. They're required to have their accounts audited. It's only if you go to the bank and say lend them money, they're a great bet. Okay? Right, I've considered the ethical issues. I now think professional issues. No problem, that's what I'm here for. Professional issues. Any hint of money laundering? They would dream of laundering money. Then they'd have some extra cash to spend, wouldn't they? I can't see at the moment any money laundering threat in what I've read. Practice management. Can't see anything in there. Liability. Yep. Because by reading that sentence, we are now liable to the bank. Why? Because we know they're relying. Says so in the story. If you say yes to this audit, you know the audit is for the shareholders but also for the bank. I would go on and say that maybe the bank will accept a disclaimer. Now they might not. They might go to Medix and say, look, we want audited accounts from you and we don't want the auditors coming in with disclaimers. If they do that, no loan. You need to find an audit firm who are willing to audit the company but not issue a disclaimer to us. Now that would seem a little unfair because the bank aren't paying us to do the audit, and I'd be tempted to go to the bank and say, look, if you want no disclaimer, my friend, you pay for that, because why would I take risk for no reason? But the fact is, in this situation, if you audit this company knowing what you know, you're liable to the bank, and that makes it a higher risk job. Spelling it out nice and simply, if the bank lend the money and then Medix goes bust and can't pay it back, the bank are going to come after you. Do you think this company might go bust? Because I do. I wouldn't lend them any money based on what I've read. Why would you? Too big a risk. So I'm starting to come to a conclusion on this audit that unless it's a very big audit fee and I've got plenty of time to do it properly, I don't think this is the sort of client I'd want to take a risk on. This is just asking for legal trouble. Back to the story. After receiving permission from Medix, you held a discussion with the current audit partner of Medix, Mick Evans, who runs a small accounting and audit practice, of which he is one of 2 partners. Mick told you the following. What you're seeing here is the professional clearance process where an incoming auditor talks to the outgoing auditor. So if in part C of the question you were thinking, would I get marks for just doing like the basic issues, like issues to consider before accepting a client? Have we got enough staff? Have we got enough time? Have we done professional clearance? You can only mention them if they are specific to the story. And clearly professional clearance won't get you marks because your firm has already done it. So you're not going to be doing it again. You can mention staffing needs in the answer because of the specialist products. If there's any evidence that they'll want this audit done quickly, and if they're waiting for a bank loan and the bank are waiting for the audit, they probably will want it done quickly, then you can mention time, deadlines, do we have the resources? But you only mention the basic stuff if you can tie it to the story. Okay, what are we told in professional clearance? Medix audit client 3 years, took over from previous auditors following a disagreement between them and the directors over fees. Okay, so this company has argued with auditors before about fees. Does that mean they'll argue with us about fees? In a job which is looking high risk and we want the fees to be pretty good, are they just going to push it down very low? I'm thinking this needs to go in the answer. As we are a small practice with low overheads, we could offer lower fees than our predecessors. We could also do the audit very quickly, which pleased the client as they like to keep costs as low as possible. Fairly clearly, we need in our answer over here to highlight that there is likely to be pressure on fees and time. And to mention that audit risk looks high. So I am extremely concerned that this is a client for whom we might not be able to do a proper audit. And of course it's a first year audit, so it would normally be expected to take longer anyway. The way they've got away with it in the past is going to a small, cheap audit firm. I'd like to think we're not small and we're certainly not cheap. During our audits, we have found the internal systems and controls to be quite weak. Is that a business risk, first of all? Well, yes, controls are there to manage risks. So in our answer, we've got yet another business risk. Not that we need any more, of course. Weak controls is a sign of poor risk management, meaning business risks across the board will be higher. So there's an increased risk now of fraud, theft, business inefficiency, etc., etc. So whenever you see weak controls, that is a business risk which affects all business risks. Is weak controls going to be an ethical and professional issue? Well, it's not really an ethical issue at the moment, but it is a professional issue because it will impact my audit process. Because if controls are weak, you know the score, don't you? Weak controls equals more substantive testing required equals increased time, staff, fees, and I refer you back to the previous point, I don't think they're going to want to pay them. Despite our recommendations, there always seemed to be a lack of interest in making improvements to the accounting systems, as this was seen to be a waste of money. Can we link that into the question? Business risk? Yes, because if they're making any decisions based on accounting systems that are generating the wrong numbers, they'll make the wrong decisions. So I reckon we can get that in as yet another business risk. If accounting systems weak equals errors in figs used to make business decisions. Pretty major risk, especially for a company in crisis. Ethical professional? Ethics, threats to objectivity? No. Confidentiality issue? No. Conflict of interest with other clients? No. Integrity of management? Yeah. If you've got a client who doesn't care about their accounts, then I would start to question their integrity. Can you rely on such people? I mean, think about it. During the audit, you find problems, you say, oh, I don't like that, and they're likely to look at it and go, ah, that's nothing. If they don't care, getting them to change the accounts and put things right is going to be extremely troublesome. Do you really want all this fuss from a client that may well be going out of business, may well never pay you the fee, and even if they do, they don't want to pay you much of a fee? I mean, why take this client on? There have been 2 investigations by the tax authorities, which we did not deal with, as we are not tax experts. In the end, the directors sorted it all out, and I believe that the tax matter is now resolved. They don't sound totally sure on this, do they? Answer: is it a business risk to have tax investigations going on? Yes. Why is it a risk? Well, if it's not resolved yet, fines may happen, and there's also the reputation damage. And with tax, especially in the current environment, that's pretty important. There have been a lot of cases of big businesses where people have chosen not to buy from them because they think they're underpaying their tax and not fulfilling their social responsibility. I mean, just think of this. Who owns hospitals in the UK? Mostly the government. How do they fund those hospitals and buy the medical equipment? Taxpayers' money. Are they really going to want to buy from a company that is seen to not be supplying enough taxpayers' money? That would seem a little inconsistent with the government's role, really, wouldn't it? Any ethical professional issues? Yes. Because if they are at risk of underpaying tax, I would say this is another point which adds to my questions about integrity of the client. They don't care about their controls and systems. They might be underpaying tax. They might have wrongly dismissed their finance director. And I'm thinking something else. I don't know. Do you remember this from the notes? Money laundering. If they have underpaid tax, that would make that the proceeds of a crime. And if they are holding the proceeds of crime, that makes them a money launderer. Which means any suspicion of tax issues, we're probably going to have to report them to the anti-money laundering authorities. Oh. Now, to be fair, most students are not going to pick up on that point, but it is a fair enough point. Do you really want the hassle with this client? You haven't even said yes to them yet, and you're already suspecting you're going to have to report them. Now, despite the fact that parts A and C already seem to have a lot of issues attached to them, we're still not done. This is a question that just keeps on giving, look. We never had a problem getting access to accounting books and records. Hooray! Finally, some good news about this potential client. However, the managing director, John Tate, once gave us what he described as the wrong cash book by mistake. What? And replaced it with the proper version later in the day. They've got two versions of the cash book, presumably with different numbers in. The one that you were meant to see and the one that you weren't meant to see. Some question over the cash inflows and outflows of a business. Money laundering? Yes. Huge potential issue. So you might not have spotted the money laundering before, but two cash books suggests very heavily money laundering, fraud. There is something dodgy going on at this company. Something very dodgy. Maybe this is why they've got cash flow problems, because maybe someone's removing money. Now, I suppose it could be the case that if the managing director has got two separate cash books, maybe the finance director found out. Maybe this is why the finance director got given the boot. Could be linked to it. Might have nothing to do with it. I don't know. We never found out why he was keeping two cash books, but cash was an immaterial asset, so we didn't worry about it too much. I'm now getting worried about the previous audit firm. They've spotted something where they should have said, whoa, money laundering, and instead said, two cash books, whatever. Bit concerning. And if we're taking over the audit of a company that's not been audited properly in the past, I'm now thinking something else goes in the answer. But let's just get to the end of this bit of the story at least. We are resigning as auditors because the workload is too much for our small practice. And as Medix is our only audit client, that pretty much answers a lot of questions. We have decided to focus on providing non-audit services in the future. Small audit firm, did the work very quickly, can't carry out the work now because it's too much for them, don't spot money laundering issues, don't seem too bothered about tax investigations. I am now worried about the accuracy of the prior year financial statements, because I am concerned of the previous audit. Now, as an incoming auditor, bear in mind there is an audit standard, not an accounting standard, ISA 510, which is called initial audits, and its primary focus is on opening balances. Because if you're the new auditor, you need to check and see if you're happy that the brought forward figures, which of course will roll into this year's carry forward figures, look about right. And I'm thinking extra work will need to be done because I'm not convinced the opening balances are reliable. And extra work means extra staff, which means extra time, which means the fees are going up, and this client wants the fees to come down. You've got a pretty good picture now from this story, haven't you? It all builds up, and going through all the points before you write the answer at all does help a bit, because now you can start pulling some of the points together, especially in part C, for reasons we'll see shortly. But before we do that, we have not touched part B, and we need to read this press cutting. Of course, the press cutting is specifically there for B part 2, but it may be it tells us things that are business risks or ethics professional issues. Extract from local newspaper. 2 days ago, so this is very current news. It appears that local company Medix has breached local planning regulations by building an extension to its R&D building for which no local authority approval has been given. Oh. The one slightly good point from the story regarding new product development is at least they've got the lab. And now it turns out the lab had no planning permission. Naughty, naughty. Now maybe you've already spotted the first risk of material misstatement here. Remember, risks of material misstatement, we're thinking which accounting standards will be relevant, which rule in particular might they have breached, overstatement, understatement, under-disclosure. Well, if you're breaking any rule, surely there's a chance you're going to get fined. I mean, we'll keep reading the story, but I'm tempted just to write in the top corner, they'll need a provision at their year-end, for the fines that are surely coming for breaching planning rules. But let's keep reading. The land on which the premises is situated has protected status as a greenfield site, which means approval is necessary for any modification. Looks like a cut and dried case then, doesn't it? A representative of the local planning office stated today, we feel this is a serious breach of regulations. That doesn't sound good, does it? And it is not the first time that Medix has deliberately ignored planning rules. Ooh, they are serial offenders. Do you know what I'm thinking? I'm thinking, yet again, integrity of client. Repeated law breaking. I mean, if they're willing to keep breaking the law, they'll be willing to keep cheating on the accounting rules, won't they? Seem to have written integrity of client a lot. The company was successfully sued in 2005 for constructing an access road, and we are considering taking legal action in respect of this further breach. We are taking steps to ensure these premises should be shut down within a month. Uh-oh. Well, that's not just a fine anymore. If they shut down these premises, they can't do the research and development work. If they shut down the whole building, they won't be able to do any work. And I'm now thinking IAS 1, this has got to be a going concern threat. Because given the situation they're in, if they have to stop the research and development they're doing, because they can't use the building. Ouch, this is big trouble. Big, big trouble. A similar breach of regulations by a different company last year resulted in the demolition of the building. Oh, crikey, this is getting worse and worse. And you can tell and be sure that if that building gets demolished, guess who's paying for the demolition work? And then has to pay for a new building if they can get planning permission. Medics. Okay, answer. Business risk. No building plus demolition costs plus fines plus no R&D equals trouble. For a company that's in trouble already, this is a disaster. Ethical and professional issues. Well, we've got integrity of client, fine. Confidentiality, no. Threats to objectivity, no. Conflicts of interest, no. Professional issues, money laundering, we've dealt with. Liability, not for this point. Practice management, no. Impact on audit, well, we've already said it, haven't we? Going concern. Wow, long answer. Right, let's see how many risks of material misstatement we can find. So we've already highlighted IAS 37. There is a danger that they underprovide for the fines relating to the breach. I suppose there's another potential underprovision here, because they may well underprovide for demolition costs, because I suspect they need to provide for them. So the point I'm getting at here in explaining all of this is that the obligation has been caused when they broke the law. They broke the law with the building. So if you want the because moment, the explanation, the obligation arose when the building was extended. And that, of course, is before the year end. A fact we know because the year end has not happened yet. It is still 4 weeks away. Now, we think that this is 4 risks with 1.5 marks for each. We've only got 2, so we're a bit 50-50. And anyway, it's safer to try and explain at least 3 risks, because who knows, we might only be getting 1 mark per explanation. But I did write in the story, sorry, it's not up here, is it? Going concern. Remember, risk of material misstatement, so accounting standard, IAS 1. What's the rule? Companies must disclose any significant going concern threats. What is the risk? They don't disclose any of this stuff. Why might they not want to disclose it? Because they don't want the bank to see it, because they'll say no to the loan. So there's 3. Now, that is easily going to get us a lot of marks, that answer. But if you are a perfectionist and you want more, and you think, look, 3 risks is not enough in part B2, I need at least 4. Well, what I would do is I'd think through the words in that press cutting and see what accounting words are in there. And I'm thinking building, and building is property, and property is property, plant and equipment, and that's IAS 16, and I've not mentioned it. So is there an issue with that building? Okay, what do I know about buildings and assets in general? You normally account for them at cost, you then depreciate them over their useful economic lives. What's the useful economic life of that building? Potentially a few weeks, because potentially that building will be demolished. Right. So maybe we should write off the entire cost of the building at the end of this year. It's worth nothing. Another way of looking at it is that buildings should be at their recoverable value and no more. And it's difficult to recover much value from a pile of rubble. I'm not sure this building has any value. I think the building is probably impaired if they can't use it, and therefore there is a danger it is overstated in value, possibly by 100%. Yes, you could, if you're mentioning the word impairment, mention 36 as well. Fair enough. But it also said this building is research and development. What do I know about development with accounting rules? Development costs. IAS 38, intangible assets. Can I work that into the answer? Okay, what do I know about development costs? They are capitalised and amortised over the useful economic life of whatever it is you're developing, in this case the new products. But there are criteria, and you only capitalise if the criteria are met. Those criteria include, it is likely that the development work will be finished creating a product that can be sold. All the evidence in this story says that with no building, only one scientist, and they can leave anyway, 4 years behind in development work, no cash. Do you know what I'm thinking? I don't think those costs should be capitalised. So I reckon we can squeeze about 5 risks of material misstatement out of that press cutting. And there we have it. We've got ourselves an answer plan. Very good question to practice this, and a very useful question for you to go back through, not today, wait a week or two and go take another look at it. It's an important question because we have business risk technique in part A. Just talk about increased costs, reduced revenues, upset customers, bad reputation. We've got risks of material misstatement technique in B part 2. Which accounting standard, which rule, understatement, overstatement, underdisclosure. And we've also got another reminder of the ethical professional issues technique in part C. Ethical, think of the 4 things to look for. Professional issues, 4 things to look for. So it's a technique-laden question. We have planned 30 of the 34 marks, and all of it is practical. Your knowledge won't get you very far. Except, of course, B part 2. Easily the hardest part of the question, because if your accounting knowledge ain't good enough, you're going to read that story. You may well spot the provision for fines and penalties, but are you going to spot much more? It's very useful if you practice looking at the real world and looking at events in the real world and asking yourself, which accounting standards apply to that? I mean, if I accidentally, with my very sharp nails, cut my tie in half, you should be thinking, oh, impairment. That tie needs writing down on Paul's balance sheet. That's how you've got to look at life. Everything is an accounting transaction or an accounting adjustment. Practice looking at stories and saying, ooh. Anyway. Now we have a plan, but there are 2 things I've not done. And that is B part 1, which I'm going to take you through now, and then the professional marks in part C. B part 1 asked what is the link between business risks and the risks of material misstatement. What is the link? Well, if this is worth 4 marks, as it is, I would be tempted to give a brief definition of what business risk and risk of material misstatement are and then link them together. Business risk is, of course, anything that could damage the company and its profits and its future success. Risk of material misstatement is anything where the financial statements are not true and fair. What is the link? Well, there's a general link, which I'll explain first, and then there are some specific issues as well. First, the general one. Any significant business risk is going to cause potential going concern threats link. Financial statements are prepared under the going concern basis. And any threats to going concern have to be disclosed. As I've seemed to have said at least a couple of times this evening, that's IAS 1. So all business risks are linked to material misstatement through the going concern issue. But there are also some specific examples. In terms of your exam technique, it's only worth 4 marks, this question. Once you've defined the two terms and then explained the more basic link, you're not going to need more than a couple of specific examples. But specific examples of issues to a business would be things like if the business has got a poorly performing division or activity, link IAS 36, impaired assets in this division. And another good specific example, as we've just seen in the question, if you've got a company with lots of legal troubles, that's a clear business risk, link IAS 37, under provision or failure to disclose contingent liabilities. So that is what B part 1 is getting at. We hadn't covered the notes on planning yet, because I wanted to go straight into a question. But that is the link, and you'll see that mentioned in the class notes when we look at it next time, which we will do very quickly, because frankly we've done planning now. A couple of things I'll be adding to it next time, but not much. 5 minutes, and then we'll be on to the next bit of the course. But to finish off tonight, in part C of the question, there were professional marks, and the reason was your examiner asked for briefing notes. And if she asks for briefing notes, your answer needs to be in the format of briefing notes. What do you need to do? Well, all you've got to do, they say the briefing notes are for someone, so to. They've been prepared by someone, so they're from you. So to audit partner from audit manager. We need a date, and your exam, I think, is December the 1st, 2014, and we need a subject. Now, the subject you are only putting in to provide the briefing notes format to get some of those 2 professional marks. So don't write an incredibly long subject. Simplify it. Issues, new client acceptance, Medix Co. You should then have an introduction, and your introduction I would keep to one sentence because again it's only there to try and earn the professional marks. So you know the sort of thing. This is for the audit partner. Here is a summary of the ethical professional issues relating to our invitation to become auditor of Medixco. Nice and simple, one sentence. Then you have the main content. And since these are briefing notes, you need some headings. Now, as long as you put headings in, that should be enough. It would be lovely, delightful, if you could organise all the points you've got into individual sections under sensible headings. Brilliant if you can. Time management in the exam suggests you probably can't. But if you see what we've just planned, in that question, surely integrity of client would be a sensible heading. Maybe going concern problems, another heading. Money laundering, another one. And then you need a conclusion. I would also make that one sentence. And let's face it, it's an exam question. You know what the conclusion's going to be, don't you? If in part A there's 12 marks for business risks, and in part C there's 10 marks for the content of ethical professional issues, what's your conclusion? There's a lot of risk at this company and a lot of ethical professional issues. Conclusion, surely, is going to say this is a high-risk audit with a client with going concern problems, and therefore the fee might not be enough to take on this risk. Realistically, decline the client would be a sensible suggestion. One final comment to make, if you want to remember what goes at the top, well, you do see that on a daily basis, don't you? I mean, is it me or is that just an email? So just pretend you're writing an email and fill in the stuff at the top. No BCC, no blind copies, just to, from, date, subject, and you're there. Anyway, we'll worry more about professional marks when we get to revision, because that's the sort of stuff we think about then. Until then, we're still covering base technique for the core question types. Next time, we will be focusing our efforts on audit evidence, which means going through loads of accounting standards and identifying what the main accounting issues are relevant to P7, relevant to audits, and therefore the audit tests that auditors would normally do on those standards. So that's the plan for next time. Can I remind you, please? Ignore that, because that shouldn't be there at all, apart from the fact it's wrong. Homework. December 2007 question 1. That is in the back of the revision kit as well. We've just seen the June 08 paper. December 07 is right before it, okay, so it's in there. Useful one to practice. But do also go back over the June 08 question 1, because it is a great question to practice. Don't worry about the kit question 19. We'll do that next time. That is fine. And can I remind you, please, that on Thursday this week, we have our first mentoring session. If you've got questions, bring them along. 5:15 on Thursday, half an hour's live Q&A. I will bring some of my own stuff, so if none of you ask any questions, I've still got something to cover. If you can make it, great. If not, as with everything, it will all get recorded. Right, superb. Where was the progress test? Yeah, Nikita, that's something I have noted. Leave it with me. Progress test questions will start appearing, I promise. Sorry about that slight problem at my end. Well, that is it for tonight. So thank you all very much for your patience and a little bit of interaction as well. We'll try and build that up as we get further into the course. Lots of accounting standards next time. So before the next class, make sure you are well full of coffee or Red Bull or whatever your drug of choice is, within reason. Because next time we're going to be working very hard. Thank you all. Have a very pleasant evening, and I'll see you in 1 week. No, not in 1 week. I'll see you on Thursday for the mentoring session. Okay? Good night. Enjoy the rest of your week.